All right, let's talk about something that is absolutely crucial for your finances. The journey from the money you make to the amount you're actually taxed on. They are not the same thing. And understanding that difference, that gap, is really the key to smarter financial planning. Okay, so here's how we're going to break it down. First, we'll nail down that difference between net and taxable income. Then, I'll show you the master formula that connects them. After that, we'll decode the deductions you can use. And this is the fun part. We'll see how to make financial losses actually work for you. And finally, we'll tie it all together into your overall financial strategy. So, first things first, we have to get one core idea straight. The total amount of money you bring in from your job, from a side business, from investments, all of it, that's not the number the government uses to calculate your tax bill. Nope, that's just the starting line.
And that really is the big question, isn't it? Well, it's because the tax system is actually designed to be, well, a little bit fair. It recognizes that not all of your income is pure profit. It allows you to subtract certain expenses, account for investments, and, importantly, factor in financial losses. This all happens before the tax rate even touches your income.
This lays it out perfectly. On the left, you've got net income. Think of that as your gross earnings, the total you brought in the door. But on the right, that's the number that matters, taxable income. That's the finish line. And the space between that starting line and that finish line, that's where all the smart tax planning happens.
So how do we actually get from point A to point B? You might think it's some super complicated process, but believe it or not, the entire thing can be boiled down to one simple master formula.
And there it is. It's really just a three-step dance. You start with your net income, you subtract a specific set of deductions, the tax code calls them Division C deductions, and what's left over, bam, that's your taxable income. Simple, right? The real power, of course, comes from knowing exactly what those deductions are. So, let's open up that toolbox. Think of these Division C deductions as the different tools you can use to legally and strategically lower that final taxable number. Now, there are a few different tools in here, like deductions for things like stock options, or a big one, the lifetime capital gains deduction. But for this explainer, we're going to zero in on what is often the most powerful and strategic tool in the entire kit, loss carryovers. Okay, this is where it gets really cool. A financial loss, let's say an investment that didn't pan out, or a tough year for your business, it doesn't have to be a total wash. The tax system actually gives you a way to turn that negative into a positive. A loss carryover is basically a time machine for your money. Seriously. It lets you take a loss from this year, where maybe you don't have much income to offset, and either send it back in time to a previous year to get a tax refund, or you can carry it into the future, saving it for a year when you know your income will be higher. But here's the thing you have to know. Not all losses are created equal. You can see here a net capital loss. That's from selling things like stocks or property for less than you paid, can only be used to cancel out capital gains. It's pretty specific. But look at that one in the middle, a non-capital loss. That is a game changer. You can use it against any type of income, which makes it incredibly flexible. And you can see they also have different expiry dates, so you have to use them or lose them. And, of course, there are some important details. For instance, something called an allowable business investment loss, or ABIL. It starts out as one of those super flexible, non-capital losses. But you gotta watch the clock, because if you don't use it within 10 years, it changes into a more restrictive capital loss. And there's this really powerful rule for estate planning. When someone passes away, any unused net capital losses can suddenly be used against any kind of income in their last two tax returns. This can lead to massive tax savings for the estate. So why are we going through all this? Because this is not just about filling out tax forms correctly. Understanding how these tools work fundamentally changes how you should be making your financial decisions day in and day out.
This quote really says it all. Using a loss isn't just an accounting trick. It's about cash. It's about your cash flow. When you use a loss to shrink your taxable income, you pay less tax. That means more cash stays right there, in your pocket. It's an immediate financial benefit.
And this right here gets to the heart of the strategy. When you're looking at a new investment, you can't just focus on the potential upside. You have to ask yourself, okay, but what if this goes wrong? Can I use that potential loss to offset other income? If the answer is yes, then the real, true after-tax risk of making that investment is a whole lot lower than it looks on paper. So we'll leave you with that thought. Because making that shift from just tracking what you earn to actively managing what you're taxed on, well, that's the difference between just having a budget and having a truly powerful financial plan. The tools are there for you to use, and now you know how to start building with them.